Hello and welcome back. This is David from the Personal Finance Squad. Okay, now we're into Chapter 13 where we are going to cover traditional IRAs and Roth IRAs. So we can see right here that we have an investment strategy. It's very basic, but we can see right here that we say that it is another financial instrument essential to planning for retirement. Depending on your choices of eligibility, meaning it can go tax-free or tax-deferred. So let's go a little deeper into this definition, and we can see that an IRA, otherwise known as an individual retirement account, is a personal savings plan, which is retirement for your retirement, that allows you to contribute either tax-free or tax-deductible. So we just said that above, and what we mean there is there are conditions as to why you can do that. So we can see right here we have a traditional IRA, and there's also the Roth IRA. These are the two types that we're going to deal with. Now, IRAs, they allow you to invest pre-tax. And that's the tax deferred we were talking about. And that's only if it's offered through an employer. If not, you have to do it post-tax or after tax, and have to do it on your own volition. Now, right here, this is important. If your employer has a 401k, that's what you should be putting your money into. If they don't, and they don't have an IRA type of plan that you can put money into, then you want to go post-tax on your own. Because if it's a 401k or it's a simple IRA or something of that nature at the employer, it's going to be pre-tax. You always want pre-tax, because not only does it lower your taxable income, and that means there's less money for you to be taxed on at Uncle Sam time at the beginning of the year, it also means that the money grows tax deferred. So you'd rather pay money later after it's grown rather than pay it out and then let it grow. Okay, so how does an IRA work? Now, it's like a 401k type of account, meaning you invest money based on your selections on stocks, mutual funds, and other securities. However, with an IRA, you can choose what securities the money will go toward. It's your option because you opened that account. A 401k only gives you a certain amount of selections that you're stuck with. So that is the benefit of having an IRA, because you can choose that money. Now, we see right here that if it's an IRA, which is really, we're talking about traditional IRAs here. Now, if the IRA is through your employer, that means you will need to open an IRA through a broker, a third-party company. That means they're going to put money into it based on their discretion, which is a simple IRA, which we have other videos for you to review this to understand it. However, if you have an IRA on your own, you're also going to have to open one through a broker. Now, IRAs can come with deductions, and you will get a deduction based on your income. That is if you open it on your own, which means you do not have a retirement-based plan through your employer. And how they determine that is based on your modified adjusted gross income, or MAGI. So let's look at the traditional IRA a little further and find out how this works. You can see here that we mentioned this earlier, it's a tax shelter. And if it's tax deferred, then that means it was put in pre-tax. That's what this means right here. Now, when you have money in an IRA, there are penalties just like all the other retirement accounts. So if money is withdrawn before age 59 and a half, there are circumstances you will pay penalties. Now, the contribution limits are not as nice as a 401k would be. So as of 2016, the most anybody can put in is $5,500, or you can put in $6,500 total if you're over 50, which is like the catch-up contribution. Now, if you opt for a spousal IRA, you may contribute another $5,500 for your spouse, whether he or she receives compensation, plus the other $1,000. So you can get up, if you're over 50, up to $13,000 in a given year. A 401k has a max of $18K or $24K over age 50. So you can see the differences here. But you have to work with what's given in front of you. So if your employer has a plan, then you choose to do that. If they don't, then you're going to have to do one on your own so that you can create this retirement savings for yourself. Now right here we see you've earned income or compensation from an employer or self-employed under the age of 70 and a half. Now, do you qualify for a tax deduction? Because right here, we see at 70 and a half, you are going to be forced to take distributions out. Just the same rules are for the 401k. So we talked about this a few seconds ago about the modified adjusted gross income. Now the AGI, you'll hear that quite a bit on your tax return. These are deductions that come off your taxable income. The idea here, right, in any tax year is to lower the amount of tax that you need to pay into the government. And that's why it's called modified, because they'll say I get tax deductions maybe for having a child, which is dependent, or you get a standard deduction as part of being in the criteria of how they do taxes. You might get deductions based off the interest on your home, things like that. Now, the modified determines if you qualify for certain deductions. So this is pretty complicated here, and to explain it would be something that would be hard for you to understand. The whole point is when you get your taxes done either through the software tool or through your CPA, it will tell you what this MAGI is. Okay, so let's take a look and see how the chart works based on your modified gross income to see if you qualify for a deduction. And you can see there's criteria here that lets you know. Right off the bat, this chart says this is the deductible chart based on if you are covered by a retirement plan at work. So when your taxes are done, you just need to look in the box here and find out where this applies for you. So you can see there's single head of household, there's married filing jointly, there's married filing separately, and then you need to go in here. So for example, you can see right here, if you're married filing jointly and you make under $98,000, a full deduction up to the amount of your contribution limit. So contribution limit, right, we looked upstairs here in the file and said it's $5,500 if you're under 50 years old. So then you would know that you could get that deduction. Then you can see it will phase out as time goes on in terms of money. So if you make more than $118,000 and under this scenario, you get no deduction. And you'll notice with any deductions, there are always phase out rules. Now you can go over here and say, listen, wait a minute, I'm not covered by a plan at work. So if you're not covered, then you can look in this chart. And you can see right here, married filing jointly again that we just talked about. If you make under $184,000, you get up to a full deduction. And the reason you're getting a higher number here to get a full deduction is for the fact that you do not have a pre-tax plan through an employer. Seeing that you've already paid tax to even put money into this, they're cutting you a break here to give you some money back. So again, you just have to look here and see where you apply and then find out what you get. Now, so you should know here that when you see these charts here, these are taken right from the IRS.gov website. And that's the best place to go because they make the rules. So, okay, as we wind this up here, just remember that if it's pre-tax, that's through the employer. If your IRA is after tax, no employer plan. And with an IRA, you choose the investments. Okay, one little last piece here at the end of this is that we want to show you what happens if you do choose to take money out before the age of 59 and a half. And we talked about those penalties, and you can see that it will be subject to a 10% tax penalty, and it's subject to ordinary income tax. And this is just like the 401k. So we have an example here that a person takes out $10,000 in the 25% tax bracket. And you can see here that will be $2,500 for this 25% tax bracket and another $1,000 for the 10% penalty straight up. So for taking out $10,000, it means you're going to pay $3,500. So that really means you're getting $6,500 off borrowing $10,000. Okay, so that's going to do it for the IRA, the traditional IRA. So just keep in mind, if it's offered through your employer, you should take it because that's the best financial vehicle you're going to have outside of a 401k through a pre-tax plan. And if you do not have that ability, then you should be looking into putting your money into an IRA. And there's also another type of a Roth IRA that we'll look into that you can choose to do. And that is the path you want to go to. You need to put your money somewhere to let it grow. Okay, so thanks for joining, and we will see you in the next video where we will cover the Roth IRA.